Hello, everyone. Good evening. I hope my audio and video are clear. So, welcome back to the session on a revision of accounting standards to help the students appearing CA intermediate examinations in this September or coming Jan. Okay. So, if you look at our beautiful ICI study material, there are so many accounting standards in our advanced accounting syllabus. So in module 1, module 2, module 3, if you look at the way how they are classified, how they are categorized, for the first time, ICI came up with structuring or basketing different standards into one category based on whether they are asset related accounting standards, whether they are liability related accounting standards, whether they are presentation based accounting standards like this. This was normally the style ICI used to follow in CA final in the old scheme. For the first time in the new scheme, they have introduced like this. So if I am right, chapter 5 is based on asset based accounting standards. These are most important for students appearing CA intermediate examinations. Okay. So the moment we say asset based accounting standards, there are three types of assets, or rather, you can say there are total four categories of assets. One is your inventory, accounting standard 2. Then the second one is property, plant, and equipment, your accounting standard 10. Then another standard is accounting standard 26, intangible assets. And I do not find any difference between any major deviations between accounting standard 10 and 26. So in my opinion, they are same. So, except one or two areas which are peculiar to only attributable to intangible assets, there might be one, two different paragraphs. Like, for example, whether marketing expenses can be capitalized, whether business promotion expenses can be capitalized. So, what do you mean by control of the asset? These kind of one, two small paragraphs are addition in accounting standard 26. But in my opinion, 99% of the standard is same. AS26 is same to AS10. So AS10 is comprehensive. So the moment you understand AS10, AS26 will be a cakewalk. Okay. So we have AS2, as I mentioned, we have AS10, which is huge. And even I think ICI study material runs into some 60 pages, which is not easy for students. I'll help you out. We'll do super quick revision of the whole thing. You'll be damn happy. Trust me. And then we have AS26. If time permits, we'll go to AS26. And then another accounting standard is, this property, investment property, accounting standard 13, investment accounting. So in that, we are going to start with AS2. We'll complete that. And then we are going to AS10, we'll complete that. If time permits, we'll go to other standards as well. And trust me, AS2, AS10, 26, and 13, if you prepare, I think definitely maybe two questions will come from this accounting standards, 4 marks accounting standards. So probably I hope you can get 6 to 8 marks minimum from attending this session. I hope this is my, genuine estimation. I'm not guaranteeing anything as such, but okay. So we'll start with accounting standard. Then when you open, ICI study material, one of the biggest challenges is the size, the volume of the standard. So how much of the data is given, especially theory? I'm not saying you don't need to read theory. I'm not saying you should not read theory. For conceptual understanding, you have to read the whole theory. But at the end of the day, when you look from the examination point of view, how much can you read? How much can you revise? So what I have done is, if you look at accounting standard 1, this is a 117-page document. You can see this is a 117-page document. I have exclusively prepared for CA intermediate students, and I'm not selling this. This is free of cost to any student. Any student who wants, Pavan sir, I want this material, text me on WhatsApp or, contact the coordinators, the office bearers. You'll get this notes. So in this, if you look at it, I'll just show you how I structured this. AS1, accounting standard 1, disclosure of accounting policies. So I have given a brief notes. What is the objective of the standard? What is the scope of the standard, and what are the key points? In the key points, I said, what is fundamental accounting assumption? We are not going to discuss anything in AS1. Just I am trying to show you the methodology, or the what we call the structure in which I have developed this revision kit. So fundamental accounting assumptions, going concern, consistency, accrual, then selection and application of accounting policies, then disclosure of accounting policies, consideration in selection of accounting policies, which are prudence, substance over form and materiality, changes in accounting policies, AS1 read with AS5, and then unusual or extraordinary items, again AS5, disclosure requirements, that's it. And the beauty is, see, I genuinely feel you don't need to read anything beyond this from exam point of view. Even if theory is asked from accounting standards, you'll be good with this. And then I have written, some of the questions from previous CA examinations, revision test papers, solved case studies, MTPs, all these things included. So May 2018, I have included this question, explain fundamental accounting assumptions. Then November 2017, what are the considerations in selecting accounting policies? May 2016, then RTP questions, then solved case studies, and then November 2015 question, May, November 2013, 2014. With this, accounting standard 1 is over. So if you look at the length of the accounting standard there, it was running into some 4 pages, some 5 pages, which covers the whole theory plus so many problems. Plus, we'll do practical questions from ICI. So this is how I have written. Now, if you look at it, accounting standard 2 is there, after that AS3 is there, after that AS4 is there, till AS29, everything is given. So this is the material. Now, keeping this aside, let us go to accounting standard 2. Let us go to accounting standard 2. Okay, now, can you tell me what is the key point of accounting standard 2? I just want some participation from some of you. So in the chat box, can you please let me know what is the key, discussion of accounting standard 2? I just want to see the level of participation. So I'm just looking at the chat box. So, give a shout. Please let me know, what do you think accounting standard 2 is all about? It is about inventory valuation, I know. Then, hello. I am checking if someone is answering. So, yeah, Jay Ranjita is saying inventory valuation. Correct. That is the title. Okay, can you give me some keywords at least? Guys, can you give me some keywords at least? Pawan sir, cost formula. Pawan sir, cost or NRV, whichever is lower. Pawan sir, FIFO. Like this, Aisha is saying at which cost inventory is recorded. Excellent. I want these kind of things. I just want some keywords. I just want some keywords. Okay, so can I get something more from someone? Hello. I am looking at chat box. I want your participation. So is there any discussion about how variable costs are to be recorded, how fixed costs are to be recorded? So what are the items that are to be included? What are the items that are to be excluded? So like that, is there anything? Okay, good, very good. So can I ask someone, can you please turn on the mic? Anyone, any participant, whoever wants, Alina, Alka, Milin. So can you please turn on the mic and say hi in the mic, please? Hello, I want someone to unmute the mic and say hi. I want someone to read the contents of the standard and then we'll do some problems. I want some participation. So, Alka, can you unmute yourself? Are you able to do it or no? So, is there any challenge? There is a restriction. No, I removed the restriction now. Jay Ranjita, can you try now, please?
Hi, sir.
Jay. Hello, madam. How are you?
Fine, sir.
Good, good. So, Jay Ranjita, where are you from?
ICI Thrissur.
Oh, so 1 hour back, we are in same class. Huh? Okay. So, can you please read the objective of AS2 for us, please? Just read out what is the objective of AS2. Jay Ranjita, are you there? Is there? I think I have removed the
prescribes the
restriction.
account.
Yes, please read it.
AS2 prescribes the accounting treatment for inventories. It provides guidance on determination of value at which inventories are carried in the financial statement until the related revenues are recognized. It also provides guidance on the cost formulas that are used to assign costs to inventories.
Okay. Continue.
Scope. The
So,
standard apply.
okay.
Scope. The standard applies to all enterprises except work in progress arising under construction contracts, including directly related service contracts. Work in progress arising in the ordinary course of business of service providers, shares, debentures, and other financial instruments held as stock in trade, produces inventories of livestock, agriculture and forest products, mineral oils, ores, and gases to extent that they are measured at net realizable value in accordance with well-established practices in those industries.
Excellent. So, guys, all of you look here. We have four components in inventory. One is raw materials. Second one is work in progress. Third one is finished goods. And fourth one is loose tools, stores, and spares that cannot be capitalized as per accounting standard 10. So they have to be treated as inventory. So these are the four items. Now that 3 or 4 items we have given here, definitions, what is inventory, then what is net realizable value, what is cost, everything is given. Now, AS2 you cannot apply to this 4. Pavan sir, why? Simple. If it is construction contracts, there is some other standard for that. And if it is, in the ordinary course of service providers, there is another standard for that. If it is shares, debentures, and other financial instruments, there are other accounting standards for that. So this is not important area from exam point of view, but please try to understand when any other standard prescribes accounting or, treatment or valuation of how something is to be valued, accounting standard 2 doesn't deal with this. That means accounting standard 2 is a general accounting standard that applies to all the industries except if there is any specific accounting standard. Okay, so there are key points I have given. Now you know that inventory should be valued at lower of cost or NRV. So there are certain concepts, certain theory points we need to discuss. But what I do is we'll go to beautiful ICI study material, and in that study material, I have taken accounting standard 2. We go to illustration 1 and let us see. We go to illustration 1 and let us see. So let us learn using practical problems, because discussing too much of the theory, is not required at this level. Point number 1. Point number 2, in the exam anyway, questions will come from practical problems, but not from theory. Okay. So Jairanjita, can you read question number 1?
Okay, sir. The company deals in 3 products, A, B, and C, which
Can you
neither
please
similar.
read? Can you please speak little louder? Your volume is very little.
The company deals in 3 products, A, B, and C, which are neither similar nor interchangeable. At the time of closing its accounts for the year 2021-22, the historical cost and net realizable value of items and closing stock are determined as follows. Item A, historical cost 40 lakhs, net realizable value 28 lakhs. Item B, historical cost 32 lakh, net realizable value 32 lakh. Item C, historical cost 16 lakh, net realizable value 24 lakh. What will be the value of closing stock?
So the question here is, should I compare the cost and net realizable value item wise, or should I do it globally? That means, Pavan sir, item A plus B plus C put together, this is the historical cost. Item A plus B plus C put together, this is the NRV. What do you think? Shall we do it item by item, or shall we do it globally? Yes, Aisha, excellent. We have to do it item by item. So put the heading accounting standard 2, problem number 1. Accounting standard 2, problem number 1. Accounting standard 2, problem number 1. Okay. inventory is to be valued at cost or NRV, whichever is lower. This should be done on item to item basis. So item A, item B, item C, and then they have given cost, they have given NRV. So value is cost or NRV, whichever is lower. Value is lower of cost or net realizable value. Okay, so can I say for A it is 40, 32, 16, 40, 32, 16. These are costs. Net realizable values 28, 32, 24. 28, 32, 24. Okay, now you tell me for item A, how much should I write in value column? What is the value of inventory? You tell me. How much should I write? Can we agree that it should be 28? Yes. Here 32 or 32, it is same. So here 16 or 24, it should be 16. So sum it up. So the value of inventory for balance sheet is 76. That's all. Value of inventory for the purpose of balance sheet is 76. So check the answer with our ICA study material. You don't even need to calculate this 88 and 84. If you are putting the totals, that is fine. But these totals wouldn't make any difference. So you cannot say, Pawan sir, cost 88, net realizable value 84, whichever is lower. So inventory value for balance sheet purpose is 84. No, that is wrong. You need to do cost or NRV, whichever is lower, item to item. So without wasting time, can we go to question number 2? Okay, read question number 2, please. Hello, madam, you should be very fast. Are you there? Or someone else, please read. If no one is there, I'll read.
X Company Limited purchased goods at cost of 40 lakhs in October 2021. Till March 2022, 75% of stocks were sold. The company wants to disclose closing stock at 10 lakhs. The expected sale value is 11 lakhs and commission at 10% on sale is payable to the agent. Advice, what is the correct closing stock to be disclosed at 31st March 2022?
Super. So when they say 75% of the stocks were sold, that means can I say 25% of the stocks were unsold? So total they bought goods worth 40 lakhs and unsold stock is only 25%. So we have to apply accounting standard 2 only for the unsold stock. Sir, what about the sold stock? 40 lakhs into 75% they sold already. It will go to accounting standard 9, no? That will go to accounting standard 9. Only the cost comes here and that too inventory comes here. So can I say that cost of inventory, put the heading problem number 2. Problem number 2. Okay, cost is equal to, we bought 40 lakhs worth of goods into in that 75% is sold, 25% unsold only I'm taking it. So this is my A point, cost is my A. And B, I'll write net realizable value. Then we'll do whichever is lower. Okay, B. So if you sell this, what is the estimated selling price? Estimated sale value is 11 lakhs. So estimated sale value, what is B? B is net realizable value. So here I'm writing estimated sales value, sale revenue. They have given clearly it is 11 lakhs. Now you tell me, I do not remember accounting standard 2. I read long time back. So whatever you tell, I'll write here. Guys, you tell me if there are any expenses incidental to sell. Shall I subtract them? Shall I write here less incidental cost to sell them? Like sales commission or something? Should I subtract it? Excellent. Excellent. So incidental expenses, sales commission. Okay, 10%. So what is 10% is equal to the above number into 10%. Okay, so can I say net realizable value is this minus this? So it is only 9,90,000. So in the question, if you observe, they said the company wants to value inventory at 10 lakhs, which is wrong. You can value inventory at 9,90,000 only. So value of inventory is lower of cost or NRV. Therefore, inventory can be valued at 9,90,000 rupees only. Can we go to question number 3? Hello, question number 3. All of you in the chat box, type 3, then we'll go to question number 3. No waste of time. I want to cover at least 25 to 30 questions. Can we do so? Do you think, are you confident that we can do 20, 25 questions today? Let us see. Okay. Madam, read next question, madam. Don't waste time, madam. Please, madam.
In a production process, normal waste is 5% of input. 5,000 MT of input were put in process, resulting in wastage of 300 MT. Cost per MT of input is 1,000. The entire quantity of waste is on stock at the year end. State with reference to accounting standard, how will you value the inventories in this case?
Important model. This question is multiple times. This is repeatedly asked in exam. So what is the input? 5,000 metric tons. Put the heading problem number 3. Input is 5,000 metric tons less normal loss. Less normal loss. He said normal loss is 5% of input. Normal loss is 5% of 5,000. Can someone help with me? My calculations are very small, very what we call bad. So can someone calculate and tell me 5,000 into 5% how much? 250. Correct. So input is 5,000. Normal loss is 250. What do we call this? This is 4,750. What do we call this? This is called estimated production. Someone is speaking. Can you please mute the call? Okay, only those who are reading out the question are supposed to unmute. Okay, so normal loss is 250. So estimated production or expected production is 4,750. But if you look at it, actual production is 4,700 only. That means there is 50 loss. So already we have normal loss. Now, what is this loss? Over and above normal loss, what do we call it?
Normal loss.
Very good, abnormal loss. So this normal loss can be included in the cost, but this abnormal loss can't be included in the cost. Why? Because this is incidental. Normal loss is incidental and unavoidable. Abnormal loss is avoidable. That means abnormal loss, sometimes, majority of the times, abnormal loss is due to what can we say? Carelessness or inefficiency. It is accident, carelessness, inefficiency, which could have been avoided. So if you incur some cost which can be avoided, why your customer will pay for that? How can you include that in inventory? Take it as a loss to P&L. So the first component can be treated as cost. Second component should be treated as loss. Is this clear? Is this clear? Now, we have considered the quantities above. Now let us look at costing. Cost per MT is 1,000. Cost per metric ton of input is 1,000. That means total cost of inventory is how many units we bought? 5,000 metric units we bought. At what cost per unit? Per metric ton, it is 1,000. So can I say the total cost of inventory is 50 lakhs? Can I say that the total cost of inventory is 50 lakhs? So do you agree with me? Give me a thumbs up, say yes. So cost of inventory of each good unit. Sir, what is the meaning of good unit? Good unit means estimated product. So what we do here is take 50 lakhs divided by 4,750. Can you tell me what is the cost per each good unit? Cost per each estimated good unit, each estimated good unit. Hello, what is the amount? So is it 1052.63? Excellent, excellent. Everybody is giving this answer. I'm happy. So value of inventory is equal to, you have 4,700 units, good units which are produced, not estimated, into 1052.632. So this is 4,700 units into this amount. So this can be included in inventory. You consumed it, charge it to production. You consumed it, charge it to production. You are carrying it, put it in raw material cost. No problem. Okay, so abnormal loss. Abnormal loss. So remember the rule. The way how we value good unit and the way how we value abnormal loss are same. The way how we value good unit and the way how we value abnormal loss are same, because both are part of 4,750. At 4,750, we have to value. In one component is 4,700 and another component is 50. So both of them will be valued in same method. So here we write 50 units into 1052.632 is equal to 50 units into this. So if you look at this, both put together will be 50 lakhs. But Pawan sir, what is the difference? This is inventory value. Include it in stock. Include it in stock value. This should be charged to profit and loss account as a loss. That's all. So are we done with question number? Is it 3 or 4? 3 is done. So shall we go to 4? Yes, Subolo will go to 4. So look here. So cost per unit, they got 1052.63. Correct. Total value of inventory 4947,368. Correct. Abnormal loss is 52632. That will be charged to P&L account. Correct. Fourth problem. Okay. Can you read fourth problem? If someone else wants to read, you can. If no volunteer is there, we have our regular person. She will read. Anyone. Read, ma. So, ma'am sahab.
You are required to value the inventory per kg of finished goods consisting of material cost 200 per kg, direct labor 40 per kg, direct variable overhead 20 per kg, fixed production charges for the year on normal working capacity of 2 lakh kgs is 20 lakh. 4,000 kg of finished goods are in stock at the year end.
So this is the question. Now tell me, can material cost be included in inventory value? The answer is yes. How? Actual cost. Can direct labor be included in inventory value? Yes. How? Actual cost. Can variable overheads be included in inventory value? Yes. How? Actual cost. Can fixed overheads be included in inventory value? The answer is yes. How? It is not based on actual cost. It is based on absorption. Pawan sir, how do we absorb fixed overheads? Fixed overheads are to be absorbed based on normal production capacity. So whatever the normal production capacity or normal working capacity is, you need to consider that, and per unit, how much you need to calculate. So based on normal production, they have clearly given that working capacity, the normal capacity is 2 lakh kgs. Okay. And fixed production is 20 lakh rupees. Can you tell me per unit what is the cost? So in a month or in a year, so they have considered one period, and in this particular period, they are producing 2 lakh cages. To produce the 2 lakh cages, they are incurring fixed overheads of 20 lakhs. So for one unit, can you tell me what is the fixed cost? Very good. Can we say that it is 10 rupees? Yes, 20 lakhs divided by 2 lakhs. 10 rupees. So include material cost 200, labor cost 40, variable overheads 20, fixed overheads 10, and include all these four. Can you tell me what is the cost per unit? What is the cost per kg? 270. Excellent. 200 plus 40 plus 20 plus 10. 270. So this is cost per one unit. Total, how many units you have? 4,000 kgs. So 4,000 kgs into 270. How much? Problem number 4. Raw material, labor, variable overhead, fixed overhead. What is the method? What is the method? Actual. Labor actual. This is actual. This is absorbed based on normal production capacity. So here they have given rupees 200. Here they have given 40. Here they have given 20. Here we are calculating it. How did we calculate? We are calculating it as 20 lakh rupees divided by 2 lakh cages. So we took 10 rupees here. So what is total cost per unit? Total cost per unit is equal to, can I say 270? So total, how many units are there? Total number of units. Total number of units of inventory, 4,000. So inventory value. So value of inventory is equal to, for the purpose of accounting standard 2, value of inventory is equal to 10,80,000. I don't want to waste 1 second also. Can we go to next question? Oh my gosh. This is done. But there is one very interesting question in test your knowledge. We'll do that also. So shall we do one more question before we go further? So Jayaranjita madam, can you read question number 6? This is not what I want to do. Question number 6 is not the one I want to do, but can you read this please?
Capital Cables Limited has a normal wastage of 4% in production process. During the year 2021-22, the company used 12,000 metric ton of raw materials costing 150 per metric ton. At the end of the year, 630 metric ton of wastage was in stock. The accountant wants to know how this wastage is to be treated in books. Explain in the context of AS2 the treatment of normal loss and abnormal loss, and also find out the amount of abnormal loss, if any.
So can you understand that this is the same problem we have done above with different numbers? Yes or no? So we are not doing it. We are not doing it. So we'll do, look at question number 8. On March 31st, a business firm finds that cost of partly finished unit. This will do. And one more problem also will do. Okay. So can you read question number 8, please?
On 31st March 2021, a business firm finds that cost of partly finished unit on the date is 530. The unit can be finished in 2021-22 by an additional expenditure of 310. The 50 subject to payment of 4% brokerage on selling price. The firm seeks your advice regarding the amount at which the unfinished units should be valued as at 31st March 2021 for preparation of final accounts. Assume that the partly finished unit cannot be sold in semi-finished form and NRV is zero without processing it further.
Super. Very, very interesting question. Now, they are speaking about work in progress, okay? This question is about work in progress. Before going into this question, we have three different types of inventory. One is finished goods. One is work in progress. One is raw materials, correct? Correct. This is type of inventory and this is valuation rule. Valuation rule. Can I say finished good, cost or NRV, whichever is lower? Lower of cost or NRV. So can I say work in progress is lower of cost or NRV? But you need to remember one thing, raw material should be valued at cost. For raw material, there is nothing called cost or NRV, whichever is lower. Raw material should be valued at cost with a note. What is the note? If the ultimate finished goods in which, if the ultimate finished good in which this raw material component is used is sold at a price which is less than its cost. That means the final finished good is sold at a loss. The final finished good is sold at a loss. So if the ultimate finished goods in which this raw material component is used is sold at a price which is less than its cost, then raw material is valued at its cost or replacement cost, whichever is lower. Cost or replacement cost, whichever is lower. So this is a very important note here. Another important note. For work in progress, NRV is not easily identifiable. Okay. For finished goods, NRV is easily identifiable. Why? Because you can sell finished good, you look at the market price and you say, Pawan sir, this is the price at which I can sell the finished goods. This is the cost, incidental cost. So NRV is ready. The estimated selling price in the market minus incidental expenses to sell. That could be brokerage, that could be commission, or that could be transportation, that could be any other incidental cost. But work in progress in its stage, you will not be able to sell. You will not be able to sell. So I used to give a small example in my class. One, flour. If you look at wheat flour, we call it flour, but in some countries they call it flour. But whatever it is, wheat flour. So this wheat flour is the raw material. Can you sell it? Yes, people are there who can buy. So you make chapati, roti or parota. That is the ultimate finished good. Can you sell that? Yes, people are ready to buy. But when you make a dough, will you be able to sell it? The answer is no. But of course, now they are selling, dosa better, idli better also. We don't know if tomorrow they sell this also. But as of now, practically, dough cannot be sold. So this is work in progress. Pawan sir, how can I calculate NRV of work in progress? Since NRV of work in progress or market price for the work in progress is not directly ascertainable, we will take the base of finished good. So what do we do is selling price of finished good. We take XXX. From this, less incidental cost. Like that brokerage or something, blah, 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 that we reduce. Okay, then can I say this is NRV of finished goods? From this, we subtract less further cost to further processing cost. Because the product is, semi-finished, work in progress. So you need to convert that into finished good. For that conversion, what will be the processing cost? If you subtract that, then can you say this is net realizable value of work in progress? So the current problem is based on this. The current problem is based on this. So what they are saying, look here, partly finished good is manufactured at 530. So here I am writing A, cost of work in progress, 530. then the unit can be finished in 2021-22 by an additional expenditure of 310. Okay, that means there is still further expenditure 310. There is still further expenditure required 310. Okay. Then the finished good can be sold at 750. Here I am writing 750 with a brokerage cost of 4% is equal to the above number into 4%. I think it would come to some 30 rupees or something. Then can I say net realizable value is 720 for finished good. But you need to spend 310 rupees more. So can I calculate the NRV of work in progress as this? No, 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 no. No, there is something wrong. No, hold on. It should be, I'm so sorry. It should be, don't do this. What you do is, from 530, can someone please subtract 310? No. Wait, what are we doing? Oh, realizable value 410 only. What we did is correct. What we did is correct. Then I got it out. Is it right? 410. Yes. B, cost of work in progress is 530. NRV of work in progress is 410. Whichever is lower. Lower of cost or NRV is 410. Therefore, each unit of work in progress should be valued at 410. Each unit of work in progress is to be valued at rupees 410. That's all. So guys, do you understand this? This is one more problem we have done. Do you understand this? Very good. Superb. So I wanted to do question number 7 also, which is conceptually very good. Okay, we'll see. We'll see question number 7 also. So, madam, are you ready to read?
Okay, sir. Mr. Mahal gives the following information relating to items forming part of inventory as on 31st March 2021. His factory produces product X using raw materials A,
Then
600 units of raw materials A purchased at 120. Replacement cost of raw materials A as on 31st March 2021 is 90 per unit. 500 units of partly finished goods in process of producing X and cost incurred till date 260 per unit. These units can be finished next year by incurring additional cost of 60 per unit. 1,500 units of finished products X and total cost incurred 320 per unit. Expected selling price of product X is 300 per unit. Determine how each item of inventory will be valued as on 31st March 2021. Also, calculate the value of total inventory as on 31st March 2021.
note this as very important because this has all, raw material, work in progress and finished goods. And this model has been repeatedly given in the exam. Okay, now, what is the estimated selling price of finished good? 300. What is the cost of finished good? 320. So can I say that the finished good is loss making? Can I say that the finished good is loss making? Is it, oh no, this is 7. Question number 7. 8 already we have done. So estimated selling price of finished good is 300. Cost of finished good is 320. Therefore, finished good is loss making. Okay. That means finished good should be valued at cost or NRV, whichever is lower. That means 300. Then raw material should be written down to its replacement cost. Because why? Finished good is loss making. So raw material should be written down to its replacement cost. What is cost of raw material? What is cost of raw material? Purchase cost is 120. That means long time back you purchased and that is there in your godown, it is at 120. Today, if you buy, what is the meaning of replacement cost? See, this is basic. Try to understand NRV and replacement cost. NRV is if I sell, how much I get. This replacement cost is if I buy, how much do I need to pay? See how beautiful accounting standards are. The person who wrote the accounting standard has a clear understanding that, hey, Pawan, listen, no company sells raw material. If you are a manufacturing concern, you buy raw material. You only buy raw material. So for raw materials, replacement cost is more prominent. That means if I buy this today, how much should I pay? But work in progress and finished goods, you sell it. You are intending to sell finished good. You never buy finished good if you are a manufacturer. If you are a trader, that is a different story. If you are a manufacturer, you only buy raw material, you only sell finished goods. So NRV is if I sell, how much I get. Replacement cost is if I buy, how much do I need to pay? So here replacement cost is 90. So it is 120 or 90, whichever is lower. Lower of 120 or 90. So can I say that raw material should be 90 rupees? Then what about finished goods? 500 units of partly finished goods in the process of producing X and cost incurred till date is 260. So for work in progress, cost is 260. Then what is net realizable value? Net realizable value. These units can be finished next year by incurring additional 60 rupees. So NRV, can I calculate it like this? Total selling price of finished good, I take 300 minus further processing cost, I take 60. So comes to 240. So each unit of work in progress is 240. So 390, 240. These are the costs are NRV or costs are replacement cost, whichever is lower. Now, Pawan sir, how many units are there? Raw material 600 units are there. So I take 600 units of raw material. Then finished goods 1500 units are there. Then work in progress 500 units are there. So we'll multiply quantity into rate or amount. Quantity into amount. So this is sum of raw material plus finished goods plus work in progress. So 6,24,000 should be value of inventory for the purpose of your balance sheet. Okay. So if you understand this, give me a thumbs up. Finished good is loss making, cost or NRV, whichever is lower. So obviously cost is higher. Net realizable value came down. Bring it down. Work in progress. Obviously cost is 260. Net realizable value is 240. Bring it down. Now here the interesting thing is because finished good is loss making, raw materials are brought down to their replacement cost. If in the same question tomorrow, if ICI says selling price of finished good is 350, my dear friends, remember, if selling price is 350, raw material here you would have taken 120. Do you understand it? If selling price is 350, cost price of the finished good is 320, finished good is profit making, then raw material should not be brought down to its replacement cost. ICI probably might have asked this question. Calculate value of inventory if the selling price is 300. Calculates value of inventory if selling price in situation B is 350. Then probably students might have enjoyed the problem more. So we are done with accounting standard 2. Shall we go to accounting standard 10?